Hello and welcome to today's webinar entitled Evaluating and Improving the Diversification of Global Equity Portfolios. I am Séverine Sibeli from the marketing team at Scientific Beta. Today's webinar will be hosted by Eric Shirbini, Global Research and Investment Solutions Director at Scientific Beta, and will feature an introduction by Arnaud Jobert, Head of EMEA Equity Structuring at J.P. Morgan. After Eric's presentation, Benjamin Rothstein, Executive Director at J.P. Morgan, will also be making a presentation of the Nexus platform. So you can submit your questions at any time during the presentation by using the Q&A function, and we will address them during the Q&A session at the end of the webinar. If you prefer, you can also use the raise hand sign at the bottom of your screen, and we will unmute your microphone so that you can ask your question during the Q&A session. So I will now leave the floor to Arnaud Jobert at J.P. Morgan for the introduction. Thank you.
Good afternoon, everybody. So I'm delighted to be here with you today and with Eric and Ben. So maybe let me start very quickly with giving you a quick overview and background, I would say, for why we are here together with Scientific Beta. So I'm running our Investable index structuring business for J.P. Morgan. I'm based in London. Obviously, J.P. Morgan has been involved now for many years on what I will call the factor side, the risk premium side of things. And what we have certainly witnessed over the last couple of years compared to 6-7 years ago is a growing adoption of factors within the strategic asset allocation of our clients. At the same time, obviously, so it's definitely an interesting development compared to some of the more, let's say, hedge fund replacement type of mandates, which we used to see many years ago, starting in the Nordics. So that's very much where J.P. Morgan is coming from. I would say a multi-asset, multi-factor, market neutral type of starting point. And on the other hand, obviously, there is Scientific Beta with a very strong footprint and a leading footprint in the smart beta equity long-only side of things. And it was a very natural synergy for J.P. Morgan and Sci Beta to partner, specifically around the use of single factors. It's fair to say that we've seen definitely across our client discussions on both sides a common diagnosis that single factors have a role to play in the asset allocation mix of our clients. The title of today's session is about improving factor diversification of an existing portfolio. It's obviously very timely. Very topical. When it comes to long-only equity allocations, we've been talking a lot about over the last few months about risk mitigation, risk reduction. Factors have been in focus, sometimes for not necessarily very positive reasons. There's a lot of talk about factor performance. The likes of value, for example, has been very much in focus. A lot of factor products out there have struggled in terms of performance. I think what is fair to say that what is a common feature or common belief of J.P. Morgan and Sci Beta is that we still very much believe in factors. We definitely do not give up on factors as a powerful toolkit in your asset allocation mix. And we think that one reason behind the lack of performance of some factors is around implementation, for sure. And I think that's something that Eric will talk about at length. But we definitely jointly believe in academic factors, in strong academic factors, in best-in-class implementation for some of these factors, and that can make a huge difference when it comes to the end result. When it comes to single factors specifically within your portfolio mix, that's very much what we call factor completion, factor hedging. We believe, again, that single factors can be a very powerful toolkit to achieve this purpose. And that's very much the reason why we've been partnering with Scientific Beta on this very broad range of single factors. So I will say we stick to our core factor view, absolutely. We do not necessarily undermine some of the challenges that we've seen around the recent performance of some of those factors, but our answer will be very much anchored into academic research. And for example, the value factor definition has been very much in focus over the last few months, and Scientific Beta has produced a very interesting research paper around incorporating intangibles, for example, in value definition, and that's also something where J.P. Morgan has been very active. So it's a good illustration of the fact that when it comes to research, we definitely share a very strong common belief in the way we can deliver some of these things. Implementation is obviously key as well, and that's obviously when we will talk about factor purity, factor intensity, which obviously is very important when it comes to improving the so-called factor diversification for a given portfolio. For again, a very key feature that Scientific Beta and J.P. Morgan very much share in common. And when it comes to implementation, just to wrap up, it's obviously here the indices, the single factor indices, obviously the Scientific Beta indices with the whole research of Scientific Beta behind. J.P. Morgan will get involved when it comes to delivering you exposure to those indices. And when it comes to factor completion, factor analysis, obviously analytics will be key, and that's where also Scientific Beta will come in with a very strong analytics offering in order to design the optimal factor mix for your given client benchmark portfolio. Now, when it comes to delivering exposure to those indices, for example, through a swap or through various wrappers, that's where obviously J.P. Morgan will step in. It's fair to say that when it comes to factor hedging or factor completion, the actual rebalancing of these factors can also be very critical. And that's where we believe that at J.P. Morgan, we have best-in-class platform, the so-called Nexus platform, which ultimately will prove to be very powerful in order to deliver that dynamic exposure to a broad set of factors to best complement your given benchmark portfolio. So that's what my colleague Benjamin Rothstein will present at the end of this session as a very concrete case study around our capabilities at JP Morgan to deliver a bespoke portfolio, an optimal portfolio of Scientific Beta equity factors to best complement and diversify your existing portfolio. So that's very much from a quick intro from my side. Again, very excited, very delighted to be part of this virtual forum today. Obviously, we're innovating in terms of format. So it's not quite the floor, but the forum is yours, Eric.
Thank you very much for that introduction, Arnaud. And yes, at Scientific Beta, we're delighted to also be working closely with J.P. Morgan. So in terms of the research that we do, we can also offer solutions which can be implemented directly as well. So it's very important for us to have the entire suite in terms of doing the analysis. So the idea is to try to analyze a client's existing portfolio and then have a dialogue with the client to try to understand the objectives they're trying to achieve. And then, of course, we also want to deliver the solution to that. And J.P. Morgan are well placed to be able to help us in delivering those solutions through investable ingredients. And the investable ingredients, as Arnaud has pointed out, are single factor indices. They can be long only indices, or they can be long short indices. And the idea is to change the factor content of your existing portfolio to have more robust performance and also to try to meet your objectives as well. Okay, so let me start first with a kind of a very general introduction. So the smart beta market is probably a very mature market these days. So you can see on this chart here on the left-hand side, we at EDEC and also FTSE have surveyed all the large asset owners around the world. And what we note is that more than 50% of asset owners around the world have invested in smart beta or made some kind of factor allocation. So this is what we mean by the market being very mature. The market has been very mature in terms of thinking about factors in two ways, really. Either implicitly, by investing in active managers, asset owners have got exposure to factors that are well rewarded. So they, if you like, they have an implicit exposure through their active managers, and that's something that we can measure. Or alternatively, they may have made an explicit choice to invest in some factors. So for example, after the financial crisis and after the credit crisis in 2011, the MinVol, the low volatility factor, became of great interest after those two crises. So people have invested in those kind of products as well, explicitly, that is. So the idea is that the smart beta, or the factor investing market, is quite a mature market, and investors are also aware of the diversification benefits. So instead of investing just in value or only in low volatility, they put these different they try to get exposure to different kind of factors as well, to try to benefit from a multi-factor allocation. Now, it's very important to, when we think about multi-factor, is how to measure that allocation and try to make sure that we really achieve that objective of multi-factor allocation. And we think that a lot of commercial tools that are out there at the moment really don't help us with those particular objectives. So we'll talk a little bit more about that in a minute. So the idea here is, first of all, is to think about the tools that we have available to measure the current factor exposure of your portfolio. That's the total portfolio and potentially the sub-portfolios, because what's also very interesting is how these portfolios interact with each other to give you the overall factor exposure. So it's very, very important to also understand the sub-portfolios as well as the total portfolio. Now, when it comes to trying to, once we've understood what your current factor exposures are, it's also very important to have an objective. And here we've listed two kinds of objectives that you can have that can improve the robustness of your portfolio. So the first way you can improve the robustness of your portfolio is making sure that you're well balanced across a range of different factors. If you're simply exposed to one factor, then that factor is going to be very sensitive to the different macroeconomic conditions, and therefore may perform very well or very poorly. So to try to improve the robustness, to get better, steady performance, trying to be exposed to a whole range of factors and to be exposed in a constant way across these factors will improve the robustness of the performance of your portfolio. It will give you performances that are going to be less sensitive and more robust to different conditions. The other objective is conditional diversification. And the idea here is that factors are also very sensitive to what happens in different economic regimes. So for example, we know that the low volatility factor is very sensitive to changes in interest rates. So the other objective that we could try to have is try to come up with a factor mix that is less sensitive to changes in macroeconomic regimes. So that's another objective we could try to achieve. So we can either try to have a balance across all the different factors to improve the robustness and not to be too reliant on one particular factor. Or the other objective is to have conditional diversification. In other words, have a factor mix that is not going to change the performance of the portfolio when the macroeconomic conditions change as well. So those are two kind of examples of the objectives we can target once we've analyzed the factor content of your portfolio. And of course, we can look at other objectives as well. So let's look at the first one of these objectives. So what do we mean by trying to improve the factor content of your portfolio? Well, there are two important, if you like, two important axes to think about when you invest in factors, and they're shown here in this slide. First of all, is the effective number of factors. In other words, how many factors are you exposed to? Now, The idea here is that you've got to be very careful how you measure your factor exposure. We strongly believe that the right way to measure your factor exposure is by measuring the beta using regression techniques of your exposure to factors, because ultimately that's what will drive the performance of your portfolio, is the beta to the factors. So how much beta do you have, and how well is it spread out across all the different factors? And the effective number of factors is a measure that tells you how well spread out you are across the different factors. So what we can see here, for example, is we can see two products here on the far left-hand side, which are supposed to actually give you exposure to one factor, for example, the low volatility factor, or in the case of the equally weighted portfolio, give you exposure to size. But what's very interesting here is we actually observe that it's got exposure to less than one factor. So we'll explain a little bit more about what we mean by that. But by trying to get exposure to one particular factor, you may actually be unintentionally getting exposure, negative exposure to other factors, and therefore cancelling out some of the good work that you're doing in trying to target a particular factor. And we see that in general for single factors, you can end up with less than one factor, and even a lot of multi-factor portfolios, a lot of factor portfolios that claim to be multi-factor end up being exposed to only 2 or 3 factors. They may be targeting 5 or 6, but if you actually analyze their factor content, you'll see that they're only actually exposed to 2 or 3 different factors. And part of this problem as well is we measure factor exposure through betas. Is a lot of products use factor scores. And factor scores are not a good way to get exposure to factors. And we've documented the reasons for that in our paper on robustness, that factor scores do not translate into factor betas. Factor scores may also give you exposure to other factors, because scores are not the same as beta. And furthermore, they don't necessarily give you the right strength in terms of exposure to a factor. The other axis that we show here is the factor intensity, which is simply the sum of the betas to the different factors. So obviously you want that to be as high as possible as well. You want as much beta as possible to the factors. So you want that to be high, and you want the effective numbers of factors to be high. So essentially what you can see here on the far right-hand side is if you're trying to improve the factor diversification of your portfolio, you want to aim for this portfolio on the far right-hand side. So this portfolio, which we call the equal factor portfolio, has an equal beta to all the 6 different factors. And if you sum up all the different betas, it has a beta of 1 to all the different factors. So the idea is we want to try to measure the factor content of your portfolio, and then look at ways to try to move that portfolio to make it a more robust portfolio by targeting the equal factor portfolio. So that's what we mean by trying to improve the factor diversification of your existing portfolio. And it can be a single strategy, or it can be a global portfolio as well. The other objective that we can target is conditional diversification. So the idea here is that, and we've done a lot of research, and we've published a paper here in the Journal of Portfolio Management about this, is that whether a factor does well or poorly depends very much on the macroeconomic regime that you're in. So in this white paper, we actually show a range of macroeconomic variables, and we show which factors are sensitive to those macroeconomic variables, which factors do well in a good outcome of that variable and in a poor outcome of that variable. And the first thing that we observe is that whether a return for a factor is positive or negative, it's very, very sensitive to these macroeconomic variables. Now, a variable on its own is not enough, because what we want to do is define a whole regime so we can combine these variables to identify a macroeconomic regime. Once we've done that, then why not try to create a portfolio that's going to be less sensitive to changes in the macroeconomic regime? So regardless of whether you're in a good macro regime or in a bad macro regime, which factor mix do you need to make the performance of your portfolio more stable, more robust through time as well. So we can look at robustness in terms of factors, being well diversified across factors, or we can think of robustness in terms of different regimes and make the portfolio less sensitive to different macroeconomic regimes. So those are the kind of targets that we can put in place once we've looked and measured the factor exposure of the portfolio. So let me just summarize this whole process. So the first stage of the process is to measure the existing portfolio, measure it in terms of factor exposure. And very important is to measure the factor exposure through betas, measure that factor exposure and measure how well diversified it is across the different factors. But in addition to this factor analysis, we also do a full robustness analysis on the portfolio to also see, because the idea is you want to make this portfolio more robust, less sensitive to changes in different regimes. So let's try to measure how sensitive your existing portfolio is to, say, changes in whether you're in a bull market or bear market, whether the technology sector is doing well or poorly. Are you very, very sensitive to that? Are you sensitive to changes in interest rates? We can measure all of these kind of sensitivities through our robustness analysis. We can also look to see how exposed you are to extreme events. So we provide a whole toolkit, we provide a whole robustness protocol that complements our factor exposure analysis, that also gives you a very good insight in terms of how sensitive your portfolio is today to different regimes, to extreme risks. And we even do an out of sample performance to see what happens if we took your portfolio and applied it to a different time period as well. So the robustness analysis is a very powerful analysis that complements our factor exposure analysis. And in fact, this robustness protocol will be the subject of a webinar that we're doing next week that my colleague Dimitris will be presenting to us next week, and by looking at some actual live strategies in terms of how robust they are. Once we've have a good understanding, once we've analyzed the existing portfolio, then usually it becomes quite clear by having a dialogue with the asset owner, with our client, in terms of, well, what is it you're trying to achieve? Are you trying to achieve better spread across the factors? Will that improve the robustness of your portfolio? Are you concerned about macro variables? Are you concerned about your sensitivity to interest rates, given that you may already have hedged your interest rates? So you want to be less sensitive to interest rates. What is it you're trying to achieve with your portfolio? With that, we can create a target portfolio, and we can look at the gap between your existing portfolio and the target portfolio. And that brings us to the final stage of the process, which is trying to close that gap in terms of the objectives you're trying to achieve. And you can close that gap in two ways. So the idea is we have single factor components that we can add to the portfolio, or we can even rebalance your existing portfolio to try to achieve your targets better. So we can have long only single factors to add to the portfolio to help you achieve your objective. Or there's the overlay approach, where we use long short factor strategies to try to achieve your desired targets. Now, obviously the long short approach allows you to change your factor exposure in a more meaningful way, because you also have the short leg as well as the long leg. So by completeness, we mean using long only single factor ingredients to help you achieve your objective. And by the overlay approach, we mean adding long short single factor strategies to achieve your objective. Now, an important part of this completeness and overlay approach are the ingredients themselves. So Scientific Beta, for those of you who are familiar with Scientific Beta, what we do is we construct single factor ingredients first, and then we can combine these single factor ingredients. Now, these single factor ingredients have a couple of very important key features. The first feature is they have a well-diversified stock weighting scheme. So to get exposure to a factor, we want to reduce our risk to stock-specific risk because we believe that risk is unrewarded over the long term. So we don't want to take on unnecessary risk. So a very key element of the way we implement factor portfolios is to use a very well-diversified stock weighting scheme because we're not alpha providers. We want to provide risk premia. We don't want that risk premia to come from individual companies, but from across a range of companies. So having a well-diversified weighting scheme helps us reduce some of the risk to this unrewarded exposure. And the second key feature of our ingredients, and this is probably even more important when it comes to completion portfolios and also overlays, is the high factor intensity filter. So the idea here is when you create a single factor, or even if you look at an active manager who gives you exposure to a single factor, more often than not, what you'll find is they are giving you a negative exposure to another factor. Remember, a lot of these rewarded factors are uncorrelated to each other, are decorrelated. So if you look at a value manager, you'll probably see they've got negative exposure to profitability or negative exposure to momentum. So you don't want to use these type of ingredients because as soon as you add say a value portfolio, you may destroy what another manager is doing in terms of momentum and profitability. So we've devised a high factor intensity filter, which we apply to each factor portfolio that reduces this interaction effect. So we eliminate the negative exposure that you get to the other factors when you create a single factor portfolio. This is a very, very important feature when you're adding a single factor to an existing portfolio. And then finally, as we say in the last bullet point here, our long-short ingredients, which are used from an overlay perspective, these are market neutral as well, because when you add long-short ingredients, you're trying to change the factor exposure. You're not trying to change the market beta of your factor. So it's very important for these long-short ingredients to be market beta neutral as well. So the ingredients themselves are very, very important element in terms of the solution that we offer. So let me now just finish up before I pass on to Benjamin, who will actually show us an example of how you can take an existing portfolio and then based on our recommendation, how you can add a factor to your existing portfolio and how that modifies the final portfolio. So just as a case study here, I'm looking at the Msci minimum volatility index. Let's say you're invested in this particular index. So the first thing we do is obviously to analyze the factor content of that particular strategy. And as you can see in the table on the top left-hand side, when you measure the factor exposure, you have a positive exposure to the volatility factor. Well, that's exactly what you want because you want exposure to the low volatility factor. And you can also see that you have a market beta which is below 1. Again, this is something that you want because you want the portfolio to be more defensive, particularly in a market downturn. But one thing that we observe here that you don't want is these negative exposures that you get to the other factors. So you can see here that our portfolio has negative exposure to the value factor, the momentum factor, the profitability factor, and the investment factor. And the reason that is a problem is because by the time I add up all of these factor exposures, including the positive ones, if I just add up the exposure to the 6 factors, that's what we call the factor intensity, you'll see that we're destroying some of the positive work we're doing towards low volatility by providing negative exposure to value. Over the long term, that's going to hurt our performance. And furthermore, it's going to make the performance of our portfolio more sensitive to different conditions as well. So the factor intensity, which measures the total exposure you have to the factors in this portfolio, we've assigned a red flag to it because it has a very low exposure because a lot of exposures are canceling each other out. So that's the first thing. It's not very good from a factor intensity point of view. You think you have a beta of 0.3 to the low volatility factor, Well, in fact, your overall factor exposure is only half that because you've destroyed your exposure through exposure to the other factors. Now, also from a factor deconcentration perspective, you can see because you've destroyed your exposure through negative exposure to the other factors, you don't even, when you look at the factor deconcentration, you don't even have a full exposure to one factor. You only have a quarter of an exposure to a factor compared to the potential of having a factor deconcentration of 6. A factor deconcentration of 6 means you have the same beta to all the factors. Well, if you actually have a very low and negative exposure to the other factors, you don't even have full exposure to one factor. So 0.25 is a very, very low number in terms of factor deconcentration. And it tells us, of course, that you're going to be very, very sensitive to how specific factors are performing. Now, the factor exposure quality that we show in the last row is simply the product of factor intensity and factor deconcentration. So the idea is you want the factor exposure quality to be as high as possible. You want the factor intensity to be high and you want it to be spread out across all the factors. And for this particular strategy, it's extremely low at only 0.04. Now, also, if we look at the robustness analysis, so we highlight some of the results from the robustness analysis, we see the strategy is also very sensitive to the market direction and also to sectors. Well, we're probably not too concerned about that because we want the strategy to be defensive. So we want to maintain the sensitivity to the market. But on the macro, we're highlighting a red flag here because even though we don't show it here, if you break down the macro, you'll see you're getting a lot of sensitivity to interest rates, to changes in interest rates. And let's say that that is an undesirable component because you've already hedged your interest rates away. So you want to try to improve that component. So let's now think, so I've just summarized these results here. This strategy has a very low factor intensity. And we note that we are prepared to accept the sensitivity to the market and to the sectors because to get a low volatility strategy, you are going to be exposed more to the utilities sector. But the idea is we want to try to improve the factor content of the portfolio, but we don't want to change the market beta. So our ideal ingredients for this particular exercise is to use long-short factors because these are beta neutral. So the idea is we want to change the factor content without changing the market beta of the portfolio. And we want to make it less sensitive to changes in interest rates as well, less sensitive to macroeconomic regime changes and shifts. So what we've done is we've created a portfolio that is less sensitive to macroeconomic regime changes. So that's the portfolio that we show in the second column here. And what we're going to do is we're going to change the original portfolio and we're going to add long-short ingredients to bring our original portfolio closer to the MRD portfolio, closer to a portfolio that is less sensitive to changes in interest rates, changes in macro conditions, without changing the market beta of the portfolio. Now, in this particular exercise, we've allowed the optimizer to add cash of 1/3 to the existing portfolio to try to change the original portfolio to a corrected portfolio. In terms of annual relative returns, you can see you improve annual relative returns by avoiding this negative exposure you have to some of the factors. And you also improve the long-term Sharpe ratio of the portfolio. Now, interestingly, in terms of drawdown, you still have protection in terms of drawdown compared to the cap-weighted benchmark. The cap-weighted benchmark had a maximum drawdown of 55%. The original portfolio had a drawdown of 46%. Well, we've maintained that 46% drawdown in maximum drawdown as well in the corrected portfolio. So this is what the factor content looks like. So for the MRD portfolio, this is the ideal portfolio we want to target. We show what the different factor exposures that you need to try to make your portfolio less sensitive to shifts in the macroeconomic regime. We show the original portfolio and then we show the corrected portfolio. Now, again, let's look at the factor intensity, the third row from the bottom. what you can see there is that the original portfolio had a very weak exposure to all the factors because you destroyed it through negative exposure to other factors. Look how much you can increase your exposure or reduce your negative exposure to the other factors while maintaining your exposure to the low volatility factor, which is the objective you're trying to meet. And furthermore, without changing the market beta of your original portfolio either. So you can see you've increased the factor exposure almost threefold. And that's why we also had better relative and absolute risk-adjusted return. In terms of factor deconcentration, getting rid of those negatives and having some positive exposure to some well-rewarded factors as well means that you're more diversified across 3 factors instead of just a quarter factor. And again, that will make your corrected portfolio more robust because you're not just relying on what happens on one individual factor. You're now spread out across at least 3 factors. And you can also see the huge improvement in the factor exposure quality of your portfolio. So again, we look at some of the robustness measures here. I won't dwell on that too long, but because in terms of interest rate sensitivity, we don't break down the macro, but in our white paper, you'll actually see that macro broken down. You'll see this portfolio is much less sensitive to changes in interest rate regimes. The portfolio is still sensitive to the market because we want it still to be sensitive to the market. We still want it to be defensive as well. But there are many more details of the robustness analysis on this portfolio. And also we actually show it for other portfolios. So for example, we showed for an ESG portfolio where you may accidentally get some unintended factor exposures. So we show how you can correct that for an ESG portfolio. We also show it for some common factor portfolios commercial portfolios that exist in the market as well in our white paper, which we'll send you along with these slides after the presentation. So let me just finish off before turning over to Benjamin to show us an example of how you can take an existing portfolio like this, modify it, and how you can monitor it as well through their Nexus system. So just to sum up, 3 main elements to this. We want to try to understand your existing portfolio. We want to measure the factor content, and we want to measure it properly through factor betas. We want to try to get a summary of your factor exposure, but we also want to do a robustness analysis. We want to stress test it in many different conditions to see how robust that performance is as well, out of sample, different market conditions, and so on. So that's the first stage of the analysis that we provide and that we work closely with our investors. And by the way, when we do this analysis, all we ask for is a time series of returns. We're not doing a holdings-based analysis. We're doing an analysis based on a time series of returns. So you don't even have to tell us who the portfolio is from or who put this portfolio together. That can be completely anonymous. We will do an analysis of your existing portfolio of the sub-funds without necessarily knowing who that strategy is from or how it was put together. After that, I think usually it becomes very clear where the gaps are, particularly from the factor and the robustness perspective, and then we can try to fill those gaps once we've identified a target in terms of what the client is trying to achieve with their portfolio, make it less sensitive to liabilities, make it less sensitive to changes in macro regime shifts, and so on. We can work with you in terms of a target, and then we can try to close that gap between your existing portfolio and the target by adding these single factor ingredients. And it's important to add these ingredients where we've taken out the interaction effect. So it's a very effective way of using a minimum allocation to change the factor ingredient to improve the robustness of your portfolio. So that's just a very big general overview of the service that we offer. But I think it's also very good to look at a practical example. And so for that, I will just pause now and turn over and ask him to switch on his screen and to share his screen where he'll show us what it looks like on a trading platform.
Thank you very much, Eric. Thank you everyone for your time. So I'm Ben Lorenstein, work in J.P. Morgan, and with Arnaud Jobert. I'm the head of the Nexus platform. The Nexus platform from J.P. Morgan aims is to allow clients to take derivative exposure on customized strategies, where the IP will sit not necessarily within J.P. Morgan, but outside of J.P. Morgan, like in the case of Scientific Beta. You probably can see my screen, and this web portal that I'm presenting on my screen right now is one of the UI which is offered to investors or users of the platform to monitor the performance of their customized strategies, as well as manage somehow their exposure to their customized strategies. And to actually go directly on the web UI, you will need to have a specific individual user access. So even though the portal is offered to all of our clients globally across the different asset classes, to be able to have access to the Nexus infrastructure from J.P. Morgan, you need to have a secure specific access. Again, because clients trade on those customized strategies, they enter in derivatives or they buy securities from J.P. Morgan to have exposure to the customized strategies and they have selected. They can also, as said, through the interface, amend their exposure, amend the strategies they have access to through the derivatives. I'm presenting here as if we were a client from J.P. Morgan Nexus, and if we had already access to a number of Scientific Beta strategies. And that would be my landing page. We have the ability to provide access to the platform through SFTPs or an API, dedicated Nexus API, but through the web interface, it's I think easier to present the capabilities and the functionalities of the platform. So as a landing page, you will have access to different menu and useful links. I'll go straight to the home menu. So on the home menu, that would be basically my own homepage as the user. Here, I have access to the Scientific Beta strategies, as well as the different benchmarks I would have selected when I joined the Nexus platform. I will immediately see the performance of my portfolio of indices, portfolio of strategies. By default, we present the 1-year performance, but obviously you can have different time periods. The different Bloomberg tickers on which we push, on the platform push every day, the performance, the level of those strategies. Those tickers are available on the side of the graph. So what the web UI is basically doing here is just grabbing from the official, grabbing from Bloomberg the official level of each of the performance and just displaying that performance onto the website. We have on the bottom of the graph, obviously, some static and dynamic data on the strategies that we have access to. As you can see, there is a color code. It's just for visual, be able to select maybe some specific strategies I want to see the performance from. But if I really want to deep dive into a specific strategy, I just need to click on the bottom, so on the table, for example, JP Morgan Scientific Beta Demo Index that we'll calculate. And then I immediately go into the overview page, and then I will retrieve a certain number of important data, performance indicators on that particular strategy that I selected. Here, you can see, again, a 1-year performance of that selected strategy. now this is an area. The reason is what we want to show, and it's not obviously available on Bloomberg, the fact that we are able to calculate as well for clients on their customized exposure back-tested performance. So you can see on the left side of the graph in dark blue, that would be back-tested levels, and the live performance of this customized scientific beta index is available on the clear blue area here, right? And I have a little tool in here that will indicate whenever I did change the underlying exposure of that particular strategy that I have access to. So let's say that I have a delta 1 swap referencing in the payoff that ticker, that GPSP GEM1 index, then at a specific date, so it was December last year, I have in my discretion and according to specific documentation around the methodology of the calculation of the index, I have changed the exposure of this demo index. It will be flagged on the graph. And so the idea here is that we keep segregated in a protected database the entire track of the different events affecting the strategy reference in the swap. We are also displaying on the website, and behind the scene, the calculation engine is the same. We're using basically in-house calculation tools called ICE, and we code in Python a certain number of reporting and analytics. So we push basic analytics in terms of risk ratios and performance. But obviously we can work with Scientific Beta if you would like to have any specific customized reportings as well. The composition of my strategy here, this composition is available on the second tab of the overview page. I can display, for example, through effective weights, or the weights of each of those building blocks underlying of that particular strategy. What is the current exposure as of today of each of those building blocks? So, for example, I have a weight in here on the Scientific Beta Developed Europe high profitability, and an effective weight of 41.1943% calculated by us. But you have also the ability to retrieve at any point in time what was the last decision I took myself according to my views and maybe my discussions with Scientific Beta, what should be the exposure on a particular day on that particular building block of the strategy, right? So all those information displayed graphically and also on the table on the bottom of the graph. And this information, which contains dynamic and static data, can be then easily downloaded from Excel here from the platform. So if I want to do some additional work analysis, I'll be able to download exactly all those data as well as a time series of that particular strategy. One of the features that we just talked about is this ability for me as a client, as for example, a swap counterparty, to actually directly amend through the J.P. Morgan Nexus platform the composition, the exposure of my specific strategy. It's a very intuitive process. We basically need mostly 3 data from you. It's an effective date when you want this new exposure to be effective, so that J.P. Morgan starts calculating the performance of the strategy according to exactly the specific exposure that you want. So the date when you want this to be implemented, the different IDs of the constituents, so the different Scientific Beta indices, Bloomberg tickers, and a weight. So it's pretty simple. It's quite intuitive, 3 steps. I will select the type of rebalancing. It could be I need to rebalance this as soon as possible. It can be that I would like JP Morgan to code already according to a specific algorithm when would be the right days for rebalancing that customized strategies. Or it could be like I want to split a rebalancing across different days. So I will select, for example, a doc, and then I will select a date. And then I will basically have the ability to change the exposure by uploading a ticket, a notification ticket, a rebalancing order, basically directly through the website. Here we are dealing with a demo strategy, so I don't have the right from a JP Morgan perspective as a structure to amend myself the exposure of these customized strategies. But the ability for me to upload the ticket would be just to, again, select the date, select the ticker, and the exposure that I wish. As you can see, you understand why also a lot of our clients are using just flat files that we exchange through secured FTP, as well as just an API to code actually the rebalancing, just to avoid going through the different steps that we see on the web UI. But again, the idea here is that we will proceed according to exactly your instructions. We will receive your ticket, and we will review the exposure that you wish to implement. We will then start calculating the strategy from the date you want this new exposure to be implemented, and we will keep in a segregated database the exact exposure as instructed by you, so that you can have a perfect audit track and recalculate yourself, if required, the performance calculated by JP Morgan on your customized strategy. I'm conscious of time. I will just finish very quickly on the reporting side. I touched base about this. Again, I mentioned it before, we're using very flexible platform that we've developed ourselves called ICE. We code through Python, and it's very flexible. So we are able to provide your data back at the format and the frequencies that you want. So it could be through a CSV, an Excel, it could be via email, it could be on a daily, weekly, monthly, whatever basis. That is something that we can accommodate easily. We just need from any client exactly what should be the data, the format, and the dissemination mode. And we will have maybe between 1-2 days of build on the coding side, and we'll be able to provide very customized reporting as well. So that's a very a brief presentation of what JP Morgan has built in regards to customized strategies that are traded through derivative and securities issued by JP Morgan. Feel free to ask any question. I will let the floor myself.
Thank you, Benjamin. So if you want to ask a question, you just have to use the raise hand sign at the bottom of your screen, and we will unmute your microphone so that you can ask your question. And you can also use the Q&A function and type in your question if you wish. So for the moment, there is no question. I don't know if Eric or Arnaud would like to add something while waiting for some questions.
I think I've covered all the points. But yes, if people still do have some questions, we can also answer them via email. Is there an email address that we provide normally, Severin?
Yeah, absolutely. The email is webinar@scientificbeta.com. And if you either have a question for Eric or for Arnaud, I'll be pleased to send a question to either of them, or even to Benjamin.
Thanks a lot, Severin. And just to reiterate, obviously, very keen to help you. And hopefully, today's presentation was fairly comprehensive. But obviously, if there's any way we can help to conduct some more bespoke factor analysis for your specific portfolio, obviously, there's something that we will be very keen to embrace together with Scientific Beta in order to make it more concrete in the context of your specific portfolio. And obviously, when it comes to implementation, I think JP Morgan will, I think you've seen from the Nexus platform, would be happy to provide you to onboard your specific portfolio, and obviously so that you can see as well as indices on the Nexus platform. So if you want to see a demo as well, in addition to what Ben has just done over the last 10-15 minutes, obviously more than happy to give you access to the platform. So feel free obviously to reach out to either Eric, Ben, or myself with any type of follow-up more tailored towards a specific portfolio that we could do.
Thank you, Arnaud. Well, I guess we can conclude today's webinar. I just wanted to let you know that I will be sending out the replay of this presentation as well as the slides. And of course, if you have any questions, please feel free to contact us. So our email address is webinar@scientificbeta.com. Thank you very much.
Thank you.
Thank you.
Thank you very much.
Thank you.
Goodbye.
Goodbye.
Bye.